Alright, so my Latin is not very good, but let me try this. Quis custodiet ipsos custodes, which when translated means who guards the guards. It's a phrase that highlights the problem of controlling the actions of people who are in a position of power. People in politics, the police force, CEOs, godmen, etc. From an investing perspective, this phrase, who guards the guards, can be loosely transformed into something like who manages the fund managers. And no, I'm not talking about the Securities and Exchange Board of India or the trustees of the fund. But instead, I am leaning more on the current practices of the investment industry that purposefully or accidentally ends up reducing the returns that we as investors can make. Now, this might seem a little strange coming from an investing platform like ours, and while we have all the respect for our partners and investors, you also know by now that we don't shy away from examining both sides of the coin. So in this video, we shall examine some practices that are related to the investment industry with a view on how it directly impacts us as investors and what can be done about it. A lot of it will be debatable and healthy debates are encouraged. So if you have a point of view or would like to add to or respectfully counter someone else's views, then please feel free to do so in the comment section of this video. Let's begin. The right incentives often lead to the right results. If you have a management title, you know what I mean. And if you understand this, you also know that the wrong incentives will most likely give you the wrong results. And the investment industry is a prime example of that. The right result that you expect from your fund manager is to achieve a superior fund performance, which means from an input perspective, you would want the fund manager to be putting in the adequate hours in tracking, researching, and identifying the best opportunities for growing your money. However, from a fund house perspective, a fund manager's incentives are aligned to something very different, which in most cases is to acquire more assets. And while it's true that delivering good performance can help acquire more assets, the performance is not the only way to go about it. Investor roadshows, making presentations to institutional investors, starting a series of close-ended funds are just some of the techniques that fund managers can use to grow their asset base. Of course, the problem is that these unconnected efforts do take away a large chunk of the fund manager's energy and time, which should ideally have been devoted in growing the investor's wealth. Now, it's not that there are no solutions for this. PMS companies in India are known to present multiple options to their high net worth clients, which ranges from fixed fees to hybrid fees and even a fully variable structure. Retail investors like you and me can of course look at index or smart beta funds, which work on a predefined system and with no active intervention are generally disassociated with an incentive arrangement. Every fund house occurs many expenses. There are payments to be made for employing an investment team, administrative expenses, operational costs, compliance costs, etc. These expenses are clubbed together and a single fee is charged to the investor, which is known as the total expense ratio. Now, this expense ratio is charged as a percentage of the market value of units that you have in that particular scheme, which effectively means that while the fund's rewards are guaranteed in the form of an expense ratio, it's the investor who ends up bearing the fruits of an uncertain outcome. In other words, the current practice of charging a single percentage neither incentivizes good performance nor does it penalize the fund for poor returns. Now, I'm not entirely sure if the current rules allow AMCs to structure expense ratios on the basis of performance or even if the AMCs want to do that. But if this were an option, then I'm sure many investors would not mind seeing this industry evolve into a base fee plus performance model. Of course, the base fee needs to be low, which can cover the necessities, which is then supplemented with a performance fee. Hedge funds do this all the time, and I'm not saying that we replicate that, but these guys typically work on a 220 structure, which means they get paid 2% of the AUM as their base fees, plus they receive a performance fees, which is 20% of the profits earned above a predefined threshold. So for example, say a hedge fund delivers 32% returns in a year and the agreed threshold is 8%. In this case, the hedge fund will make 2%, which is the base fee, plus 20% of 32 minus 8. So that's 2% plus 4.8%, which comes to 6.8%. So if you do a splitting, then the investor keeps 25.2% and the hedge fund keeps 6.8%. Now there are many variations to this, and like everything, there are pros and cons to every structure that comes around. If your boss tells you to hurry up on a task or a project, there's a good chance that you'll cut corners and prioritize short-term returns over long-term growth. The investment industry is also a bit like this, with many investors seeking performance in the short term, which then forces fund managers to focus on the next quarter rather than creating wealth over the next decade. And this myopic approach to value creation is just about everywhere, with companies who have to report quarterly statements, with equity analysts who are trying to quantify quarterly changes even if there is nothing there, institutional investors who have to report good news to their board every 3 months, and of course with fund managers who hate seeing their AUMs go down because of 1 or 2 lackluster quarters. So what can a long-term investor do in such a scenario? Well, one way to go about this is to invest via long-term instruments, ELSS funds, some retirement saving funds, and of course the National Pension System or the NPS. These products have a moderate to high lock-in period, which gives a more flexible investment mandate to the fund manager, which in turn helps them identify companies that can generate returns over the long term. A second approach that can be explored is to invest in funds that are structured to attract only long-term investors. For instance, the fund that Monish Pabrai manages is structured in a way that it allows redemptions only once a year. Other examples of such funds would include closed-ended funds that have a maturity of 5 to 7 years, and also some open-ended equity funds that have an exit load structure, which is a bit on the stricter side. Window dressing is a strategy that is aimed at improving the appearance of a fund's performance without actually improving the fund's performance. In other words, these are just some cosmetic changes made to hide some of the inefficiencies in the fund and to show it in better light. For example, a portfolio manager might look to exit some of his bigger loss-making stocks so that he doesn't have to explain the holding in these stocks at the quarterly investor meeting. Similarly, the fund manager might look to buy some recent winners right before the quarter ends to make the portfolio look very attractive to the investors, although they never got any benefit of this recent appreciation. Another variation of window dressing is where a fund manager can boost a fund's returns in the short term, which might otherwise have a negative effect on the longer term. For instance, one might invest in stocks that do not meet the investing style of the fund. It's like when a fund manager who practices the value style of investing goes ahead and invests in an IPO of a non-profitable internet company only to capture the listing gains. These window dressing practices provide yet another reason for an investor to carefully monitor a fund's performance reports and to look out for stocks that seem to be out of line with the fund's overall strategy. Closet indexing is a strategy used to describe funds that are actively managed but have a portfolio construct that is not very different from the benchmark that they are chasing. To put it another way, think of it like having a large cap fund in your portfolio whose benchmark is the Nifty 50, and the holdings and weights of this large cap fund are not much different from the Nifty 50. In effect, this large cap portfolio manager is aiming to achieve a return that is similar to the underlying benchmark, which in this case is the Nifty 50. Now you might be wondering, why would any fund manager want to do that? Well, for one, it lowers the risk of underperforming the index, which in today's world is rather important, with over 50% of the actively managed funds struggling to beat the benchmark. But the flip side of this approach is that it also kills outperformance, which is what we as investors expect the fund manager to do, or at least try to do. And hence it should come as no surprise that closet indexing is looked upon very negatively, because what's happening here is that the investor is paying a much higher management fee for a fund that is simply mirroring an index fund. Now, one way of detecting if closet indexing is happening on your fund is to look for the fund's R squared. The R squared is a statistical measure that explains the degree to which a fund's performance can be attributed to the performance of the benchmark index. Simply put, if a fund's R squared is closer to 100%, then its performance is more aligned to that of an index. If you want more details on R squared and other risk measures like alpha, beta, Sharpe ratio, etc., then don't forget to watch the video on mutual fund risks on our YouTube channel. The investment industry has done a lot to financially improve the lives of millions of people around the world. And along this journey, among many highs are also many complexities like the ones we have discussed in this video. Now notice I use the word complexity, and that's because investing is complex. It's complex because modern investing is a concoction of innovative products, short-term expectations, a for-profit business, unpredictable economies, etc., etc. But all said and done, knowledge is power, and in this video we've tried to give some perspectives on why certain things happen in this industry, what are the motivations behind it, and what can you do as an investor to control it better. Before we close, I'd like to borrow something that Tom Coutts wrote in an article which has been the very motivation behind creating this video. For too long, the investment industry has taken inspiration from the Olympic Games slogan, faster, higher, stronger. Faster trading, higher fees, a stronger position relative to its clients. But what the investment industry should be targeting is the exact opposite. Slower, lower, and weaker. Slower levels of portfolio activity, lower fees, and a weaker position compared to its clients and society. That's hardly a rousing slogan, but it sure is an optimistic one, and one that would mean that investment firms are doing a better and a more valuable job. And with these words, we come to the end of this video. Once again, thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.